is Trepp with a special guest podcast, the CRE Finance Outlook. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. And joining us today are two leaders from MBA, the Mortgage Bankers Association, Jamie Woodwell, Vice President, Research and Economics, and Mike Flood, Senior Vice President, Commercial Multifamily Policy and Member Engagement. That's hard to say all at once.
It's an awful lot, but thank you for having us. And just call me Mike Flood, Commercial Multifamily. That works.
Perfect. Well, welcome. In your current roles, you serve complementary functions with research and policy at MBA. Give us a quick overview of your backgrounds. Mike, if you want to start first.
Sure. Again, thanks for having us. And about 25 years in the industry, and as I like to say, half in the association world and half in the business world. I was at a fellow association before MBA in the Commercial Real Estate Finance Council that I know you all know very well. Before that, Structured Finance Industry Group. Before that, White House OMB working on TARP. And before that, I was at KPMG and Fannie Mae working on the commercial and multifamily side of the business, either through the auditing transactions or through the compliance programs. And now at MBA, running the commercial division. What does that mean? I'm in charge of our membership as far as growth, as far as advocacy, and as far as making sure we're providing value back to them as it comes to providing programs that are accretive to their business, such as our Empower and Impact programs. With that, why don't I hand it to my colleague, Jamie, to walk through his portfolio.
Yeah, sure. Thanks, Mike. So Jamie Woodwell with the Mortgage Bankers Association. I'm in our research and economics group. Been here about 16 years now, so through a few cycles. And I oversee our research on the commercial and multifamily markets and policy research. Other things, oversee our peer business roundtables and our CREF careers program. That seeks to attract students to the commercial multifamily industry. I came to MBA from Fannie Mae. I've been working in commercial real estate and association research for probably too long to count at places like the National League of Cities and the Washington Area Housing Partnership, among others.
So you recently had your conference, and unfortunately, like many of these conferences, it was virtual. I think it was slated to be in San Diego, which we would have loved to attend, but it wasn't. And alas, it was online. Give us a little overview of what some of the highlights were from that and anything that was a surprise.
Sure. Well, thanks again. And you're right. Virtual is always a tough environment, especially when you have San Diego on the mind. But what we did is we combined two of our conferences together, the CREF conference, which is really our deal-making conference, with our servicing conference, which is the largest servicing conference in the industry. And the learnings, to your point, the things that came out that were surprising, and maybe it's just my linear mind, is that you can't really, in my humble opinion, pinpoint specific pain points per asset class outside of possibly hotel and retail. And what I mean by that is when we talk to office, I hear people talk about office in different ways. Office doing well, maybe in Tennessee and Texas, but then the questions raised about what will the future of New York look like? Will that be suburban based, or what will that do? And I think the surprise to many, maybe not to all of us, was how big a role diversity and inclusion is now playing in the industry. To me, it's not a surprise that it is an issue when most of the industry looks, quite frankly, like me, but the severe focus on it in a positive way was surprising to me. And we tried to show a little leadership there through making sure that our panels had at least one minority or woman on it, and we were successful. Now that's a floor and it's a start, but the surprise to me is that focus was throughout almost every panel that I saw. So it wasn't just about the performance of the industry, but it was about what should the industry look like as we go forward.
Building on that, the CREF convention is always a great way to start the year. Folks getting together, sort of hearing what other folks are seeing in the market, what the hot topics are, what the appetites are, and that always goes swimmingly when you get everyone together in a place like San Diego. I think one of the surprises to me was how much information still did sort of change hands or change minds during the conference through the panels, through the conversations, either formal or informal. So I think that was a real positive. And coming out of that, I think maybe one of the surprises, which maybe shouldn't be so surprising, is really the resilience of the industry, and that even though we're still in the throes of an awful lot of elements of the pandemic, lenders, investors are all working at what are the deals that can be done, how do you go about doing them, and really sort of keeping moving forward in all the finance that's out there.
You guys mentioned before that you've been through a couple of these wars before, the great financial crisis being the big one. A lot of tools are being used by the Fed, by Congress and others. Did you get a sense that there was any kind of consensus with your membership about what's working and what's not working? Obviously, we've seen TALF, which has helped lending spreads. We've seen the markets flooded with liquidity, and we've seen things like Eviction Moratorium. What do you see working? And is there a consensus with your membership, or are they all over the place in terms of the needs of covering the gaps?
Yeah, and I'll let Mike dive into some of the specific policies. One of the things that I think is pretty universally seen has been, particularly on the multifamily side, the success of some of the government stimulus and other programs. That if you look at the PPP, the expanded unemployment insurance benefits, the rental assistance, the massive disruptions we've seen in the labor market really haven't bled over into many elements of the rental market. And you see that in National Multi-Housing Council data on share of renters missing rents. You see that in some of our mortgage delinquency numbers. So one piece that I heard, and I think that we've seen, is that those programs have really been wildly successful in supporting the rental market.
Yeah, and to be quite frank, I think, sticking with multifamily for 1 second, then we'll venture over to commercial writ large. I think what surprised us at the very start in March is our members were very nervous about any eviction or forbearance requests from policymakers, especially eviction moratoria. Geez, what's that going to do? And I think what surprised us is we were very happy to see unemployment insurance pass, but in the first CARES Act, we had also fought for rental assistance that was not included. And I think, to all of our surprise, the direct checks and the unemployment insurance seemed to carry the day, at least to Jamie's point on the numbers through September. And then the ability to convince Congress in December to add rental assistance to the stimulus package along with unemployment insurance. We're very interested to see how the $300 a week works along with the rental assistance as we go into further debates. What didn't work? Main Street lending programs, some of the liquidity facilities. I think, Jamie, I'll hand it to you in a minute, but when you see that hotels and retail suffered, and through no surprise, we're all mandated to stay home. So how can they possibly make money? I think what surprised me is we saved only part of the food chain. We helped the airlines, but we didn't help the destination. And then when we look at the Main Street lending program in the PPP, while very successful for a lot of small businesses, didn't quite have the right setup to help hotels specifically. And may not have had the EBITDA requirements to help some of the smaller apartment owners out there. So positive on the multifamily side. What wasn't working is how do we help hotels and retail who are suffering under at-home mandates as well?
Back in 2007, one of the big problems was asset inflation, right? That we saw, things getting refinanced every 2 years with, in the cases of apartments or offices or other things, 25% asset gains in 2 years. Was there any dialogue at the conference about people being concerned about there being too much liquidity, especially in the industrial or multifamily space? Anybody concerned that there's just too much money swashing around and there's going to be some unintended consequences?
Yeah, I'll take a first crack at that. I think there's absolutely an awful lot of money looking to get invested right now. And that's not just across commercial real estate, but across all asset classes, from treasuries to equities and other things. So folks are definitely keeping an eye on that. And one of the pieces that's really interesting in this market that you hear folks sort of grappling with is there are the property types that investors and lenders feel more comfortable about. And so you've got an awful lot of folks focusing their attention and investments there. And then there are the less favored property types that aren't attracting as much attention and therefore are getting some higher yields. And so I think what everyone's trying to figure out is what's the right risk return balance for everything. So if you're looking at some of those hotter property types, how low a yield, cap rate, et cetera, are you willing to accept versus maybe taking on a little bit more risk and getting a little bit bigger yield? And that's really nothing new for lenders. The challenge, I think, in recent years has been the overall yield or interest rate environment has been so low that you look at some of the top line numbers in terms of those yields and returns, and they look pretty skinny. To your point about the global financial crisis, if you look at the spreads, cap rate spreads going into that, back in 2006, 2007, cap rates basically didn't have any premium to the 10-year treasury at that point. So when investors started getting skittish, that cap rate spread jumped, and that's when we saw that very dramatic drop in property values. Interestingly, going into this downturn, that cap rate spread was relatively healthy. So it was already at a level roughly that it was at after it had adjusted during the global financial crisis. So by contrast, what we've seen this go round is that even with the pandemic and the recession it brought on, we haven't seen cap rates spreads really need to jump to adjust for changes in investor sentiment. And in some cases have actually come down to adjust for what people think are temporary impacts to NOI. So valuations have been really pretty darn steady through this downturn. And I think that's actually giving people a lot of solace as opposed to concern.
So looking at some of the market indicators that your organization has put together and published recently, what does it reveal about the health of the industry?
Great question. And one of the nice things about this time of year is we're just starting to get all the year-end data. So we can put a bit of a bow around 2020, which maybe helps us look forward to 2021 a little bit more. But to me, one of the more striking pieces of information is information we just came out with on our quarterly originations index. And so that shows each quarter the amount of lending and borrowing that takes place. And one of the key points there for me is that if you look at the fourth quarter of 2020, it was about 18% below the fourth quarter of 2019. So we saw a drop in production, but that's compared to drops of 50% in the second and third quarters. So actually some relative improvement there. And then when you dig into it, you start to see a point that was raised earlier, this real differentiation by property type, that industrial and multifamily, you actually saw increases in the 2020 fourth quarter compared to the 2019 fourth quarter. So we saw a pickup in interest of lenders and investors to go into those property types that they feel more comfortable with, whereas retail and office, where there's a little bit more uncertainty, a little bit more concern, there we saw the drop-offs. So I think that's sort of that wrap up and some of the momentum coming into 2021. Some of the other data that we can get into or that folks can check out on loan performance and other things really backs up that story and the impact of property type being the key driver of how folks are looking at the market today.
So Jamie, within the multifamily segment, which I know is, your guys' big area of focus, especially in terms of originations, are you seeing even a dichotomy there or some stratifications there? I mean, we hear anecdotal evidence of, big city luxury multifamily having much less of a bid for debt as opposed to B and C plus, middle of the country type stuff.
Right. Great question. And point to note that we love all property types. So,
I knew I was going to get you a little bit miffed there by saying that. Historically, very multifamily centric, but not so much anymore.
And the market has been so multifamily centric over recent years. There's been so much more taking place. I think two points on that. One is that early on in the pandemic, we absolutely saw the concern from a number of investors and lenders was on that renter ability to repay. And were we going to see stress coming to the multifamily market? And if so, sort of how do you work through that? And there you can imagine property classes being a key differentiator, some other things. More recently, what we've seen is that while there still remains some concern about the renters and sort of stress on renters bringing stress to the market, really a higher area of focus, greater area of focus has been this differentiation from those coastal markets that might be a whole lot denser, that have some new supply coming online, and where you see actually the strength of renters and their ability to sort of force competition amongst landlords, driving reductions in rents, concessions, and other things. So that's very market specific, absolutely having an impact in those markets, from the rents and concessions onto the NOIs, and therefore sort of how a lender or investor is going to think about those properties. I do think probably the greatest differentiation in multifamily on the lending side this last year has been government-backed versus non-government-backed. That if you look at lending that took place in 2020, Fannie Mae and Freddie Mac, and in particular FHA, had record years in terms of mortgage originations, that a lot of refinance activity and also some acquisition activity too, driving those sources of capital to record highs, where you did see a pullback from some of the other capital sources in terms of their ability to get money out the door.
It's funny, I was chuckling while on mute, so nobody heard my chuckling. But to hear you say you put a bow around your data in 2020, I think we were putting a set of cement shoes on our data at the end of 2020. I think that was, for us, it was more fitting considering how we saw such dismal downturns in hotel and retail. Going back to your conference and the vibe that you were getting from your membership, what did they seem to think recovery would look like, particularly like you were just saying in those hard hit cities? From our data, San Francisco and New York, we've seen sizable downturns in occupancy among the high-end properties. Of course, people are talking about offices being physically occupied 15 or 20%. What would you say the vibe was at the conference for what a recovery would look like? Is it 75% of pre-pandemic? Is the office market fundamentally different? Is it slow to come back on the multifamily? I'll just open up the floor to you guys, and you can go let us know what you felt was coming out of your membership.
Sure. Why don't I talk from what I heard, and then we'll go to the true numbers with Jamie, and you'll see how those two compare. But what surprised me, Manus, was the utter debate between what a recovery would look like. We had members who are looking at it and saying, "Great, once we get shots in arms, we're back to the races again." And I wouldn't call it a blind eye. I'd say, that's the mindset of people want to get back to work. They want to be back downtown. And it comes with a mindset of, if I have younger workers, I need to get them in the office so they can create that network that I already have. Then there was the other debate, which was, hey, we're gearing up to have high yield and distressed debt funds. It's coming. And just like the last downturn, three things stick out. Some of these will sound pretty classic, but hey, the retail downturn is just sped up by a decade, so we have to deal with it. And so the inevitable is happening. B, boy, should we be looking near Vanderbilt University instead of by Columbia University for our next foray. And three, a little bit of uncertainty in the fact of, this is what we think. However, we have an office lease for the next 2 years. And so really the vibe I got on office specific was, yeah, there's going to be a change, but we're actually not going to see it for a couple of years until some of these leases expire. Whereas in other asset classes, we'll see it more immediately. When you think about retail and hotel, we'll see that a lot faster than office. Jamie, let me pitch it to you, but that was the vibe. It was a true debate on whether we're actually going to see damage and how fast.
Yeah, I think that's spot on. And when we've been hearing investors, lenders talking about the market and different property types, we've sort of heard four categories of different property types. And the first category is countercyclical. So property types are actually getting a little bit of a boost through what's been going on in the pandemic. Industrial with all the logistics demand, self-storage, single-family rental being sort of poster children there. There's also, as Mike mentioned, the accelerated. So there were changes taking place for a particular property type, and this has just sped that up. So I think people would generally put malls, and particularly certain types of malls, in that bucket. The third would be property types that we may have a changed relationship with going forward. And no one's quite sure what that changed relationship is going to be, but that we think that the way we used to treat office probably isn't going to be the way we're going to treat it going forward. What that means, lively debates about that. And then the last one is sort of speed bumps. And these would be the property types that were sort of chugging along before the pandemic, have the pandemic, the recession associated with it, that have disrupted them. But the thought being that afterwards, those might sort of kind of get back to normal. And there, I think you'd have hotel and multifamily thrown in there. So each one of those are generalizations, and the property subtypes are going to be going in different directions and other things. But I think those sort of characterize what we've been hearing about people's thoughts, where different properties might head.
Just one other thought that was starting to swirl just above this, which is, a lot of folks are very happy with the TDR relief that's been granted, so they can take the opportunity to work through loans. And we're proud to have worked with ACLI and CREF21 and others on that. But then the question became, how much relief is too much? When do we start to make the decision as to whether, for lack of a better word, we save, rehab this property, or that we move on? And so that question starts to come up a little more and kind of factored into all of this, which is the relief is great, but geez, when do we need to make a decision on this?
So I was just going to point out that Jamie had written a piece for the Commercial Real Estate Direct year end, and he talks a little bit about the different property types and how new normal will look different for each property type. So I encourage you to look it up either on the MBA site or on the Trepp site and pull that down and read it in more detail. Shifting to policy discussion, obviously new administration means new priorities and new policies. So what are the things we should be on the watch for?
I will try to do this at a 50,000 foot level. But the highest level I would leave you with is the Biden administration came in with 4 pillars. And those 4 pillars are COVID relief, climate change, affordable housing, and diversity, equity, inclusion. And the way literally everything they do is framed will be through those 4 policy pillars. And what I mean by that is, as we've seen the Biden administration put forth people to take over the agencies and run them, what we have noticed is literally every agency has put in a climate change person in order to oversee how they will tackle climate change. When you look at the regulators and who has been appointed in hopes to run it like a Mr. Barr, they tend to be slightly more progressive. So while the agency heads seem to be more middle of the road Democrat, you have the banking regulators who tend to be a little bit more progressive. So very quickly, at a high level, the first thing out of the gate will be stimulus. Biden has asked for it. Democrats look to be going on their own. What does that mean? They'll use a trick called budget reconciliation to try and pass a stimulus package by a majority vote. And their goal is to get that completed by March 15th when unemployment insurance benefits run out. So their goal is to tie those together. So Martha, very specifically on that, what we like are the $1,400 in direct checks, the increase in unemployment insurance from $300 to $400 that would go till September, the increase in funding in rental assistance, as well as some grant programs and venture capital in order to help small businesses. What we still have a question mark on that we don't see is any provisions for forbearance. That makes us happy. And then finally, we still don't see help for hotels and retail, and want to continue to work on that. But going forward, things to think about. If you are and I'll march by capital source. If you are a bank, expect increased regulation and increased supervision over your portfolio. Expect that the Community Reinvestment Act and disparate impact rules will be revisited. in order to make sure that they are equitable and expect higher capital standards. And if I am a bank, then I'm starting to look at the Bank for International Settlements as my key as to what the federal regulators will put in place. The same goes for insurance companies. But on the positive, the NAIC has a proposal in front of them to lower the risk weights for equity investments that they want to get done by the end of the year. So that could be very helpful for life insurance companies. On the multifamily side, GSE reform is going to be a very interesting topic. Dr. Calabria, who runs the FHFA, is in place right now and is marching very quickly to try to get them out of conservatorship. However, the Supreme Court will decide whether he can be removed at will, likely before June. And if that's the case, Biden is likely to put in his own head of the FHFA, and that would likely change the course of where the GSEs are headed. Think about it this way: their caps are at 70 billion with no exceptions. You get someone new in, you may have exceptions for green lending. If you think about that as the pillar for the Biden administration's climate change, you could see exceptions to the caps come back again. And then finally, staying with the CFPB now, two aspects of multifamily we have to be wary about. They could be looking at a renter's bill of rights. We've seen that in New York State and California, and that could be taken up at a national level. And two, the HMDA reporting requirements require to report on HMDA if you do 100 loans or more. That could get revisited also. And finally, if you're in the CMBS world, two things to look out for in the SEC. One, the Franken Amendment is still hanging out there as far as the issuer pays model, and Gary Gensler, who is likely to be the SEC head, has called for increased disclosures. So I wouldn't be surprised if they take a look at Reg AB 2 to see if the disclosures in public deals should also apply to private placements, as well as what disclosures may be required for climate change. So that's a very high level overview, but those are the things that we are looking out for and forming task forces to take on over the next year.
So your membership, I'm sure, is laser focused on anything that would push up the cost of lending in any way, or the cost of regulation and so forth. Is there any one or two of those that are unusually alarming for your membership that you say this is something we really have to fight for because this would have the unintended consequences of making things more illiquid or more costly for homeowners,
Sure.
Commercial property owners, et cetera?
Yeah, great question. The first is certainly COVID relief. The Biden administration wants to make sure, and quite frankly, we do too, that everybody can stay in their homes, in their apartments, with a roof over their head until we have shots in arms. The thought process is September right now. I'm sure that's anybody's guess. So we're very focused on the stimulus bill and making sure that unemployment insurance direct checks are extended through September, especially if the eviction moratorium is extended to September as well. But you're right. I think what we want to make sure of is, there's a phrase used a lot in commercial called death by 1,000 cuts. Manus, I wouldn't point to one specific proposal, but if I'm a bank, I'm very concentrated on the amount of capital they may hold against me, plus disparate impact and Community Reinvestment Act. I think banks really want to make sure these work, and they don't want a red line, but at the same time, every time we increase regulation, increase costs. So we want to make sure that we have a level playing field. So I would be concentrated there. And then finally, for every capital source, GSE reform affects everyone. So I think starting in June, when we get that Supreme Court decision, is going to have a tremendous effect on what the market share is for GSE versus non-GSE lenders, and quite frankly, how we go about affording affordable housing. And I'll leave one more, Manus. The affordable housing mandate is extraordinarily important. One thing that we are worried about is there's an old program that used to be run through HUD called the Federal Financial Bank. And that bank provided low-cost funds to PHAs with the good intention of creating more affordable housing. Well, that competes directly with FHA lenders as well as other affordable lenders. So we all want to provide more affordable housing. What we don't want to do is compete with the government when we have plenty of lenders in the private space who will do the business. So those are the three areas where we're very concentrated on. Jamie, am I missing anything?
The one I might throw in there as well is taxes. Commercial real estate.
Oh, that little thing.
Commercial real estate being a very capital intensive business, that changes to taxes can have a pretty dramatic impact on incentives for developers to develop, for owners to own. So we'll absolutely be keeping an eye on that. I know Mike has already been doing a lot of work there.
Oh, and Jamie, first off, thanks for bringing it up. I was thinking linearly. COVID's going to happen first. We would expect that as the year goes by, in the second half of the year, we'll start to see a focus on tax reform. Doing both at the same time is very difficult. But if you're about to spend money, you're looking for ways to pay for it. And the easiest way to say it is name the tax provision that we care about in commercial, and it will be on the table, from business interest deduction to 1031 exchanges to, quite frankly, higher capital standards at lending institutions. So we're all going to have to, I hate to be a realist here, but I have a hard time believing that all of our favorite children will be saved. So we really have to concentrate on which ones are most important to us and which ones we may need to reform. Maybe it's carried interest, where we have to make a decision on what's livable for commercial real estate.
So, Mike, you talked about GSE reform and potential moving out of conservatorship. So for those that live a little bit outside of that world, give us a sense of what that really, we all understand the GSEs are Fannie and Freddie, FHA, Ginnie, et cetera, right? And they provide half or more of all the multifamily debt, right? But what happens if they do actually exit conservatorship?
Joe, that's a great question. And I think that's the philosophy that we're trying to decide right now. Under Dr. Calabria's philosophy, the current head of the FHFA, I believe he looks at it in three ways. A, how do I create a level playing field for all lenders? B, what's the true mission of the GSEs? Is it liquidity or is it affordable housing? And I think it depends on the day as to how you look at that. And when you look at how Dr. Calabria has moved on the caps, I think he sees it as a little bit of both. He's reduced the caps from 80 to 70 billion, certainly based on projections of how many originations are done. But more importantly, he's moved up the percentage of that must go towards affordable housing from 37.5% to 50%. So, Joe, the best way to say, to answer your question in as short a way as possible is, A, when the GSEs come out, I think the question becomes, will they be providing cheaper financing because they are focused on affordable housing? Or will they be seen as a level playing field that competes directly with CMBS and portfolio lenders? And how do we get there? And what I see from Dr. Calabria is increased capital standards, increased capital to hold against, as well as shrinking the types of business they can do. I know earlier on there was a look as to how much construction lending they could possibly get into, if at all, and how much CRTs they could do, and that's starting to be shrunk. So the current philosophy is to get them more towards a public utility, more towards a level playing field with other lenders, and more concentrated on affordable housing. That said, if Dr. Calabria is asked to leave by the Biden administration, that philosophy can drastically change, which then drastically changes the effect on life insurance companies and CMBS. And our theory is that if there is a change, that likely slows down the ability to take the GSEs out of conservatorship, and you likely see more of an expansion or concentration on affordable housing and potentially green lending. While that's a good mission, what that suggests to me is that is an expansion of the market share that the GSEs could have, especially if they get into green lending, and it's an exception to the cap. Joe, I hope that answers your question, but that's kind of the two philosophies we have to look at until we get a decision on who the FHA director is.
Well, as a CMBS homer, whatever we can do to get a little bit more multifamily in CMBS would make me happy. And by the way, Mike, you're a pro for not getting distracted by my 2-year-old running into the room.
Well, Joe, if I was at my house, you would have doubled the amount of people behind you and at the same height requirement. But to your point, I think this year is going to be a great test for that, Joe. Seeing the caps get lowered, seeing the affordable housing percentage get kicked up, in essence, leaks some of that market share into the private sector. So we're very concentrated to see how life insurance company allocations change, very interested to see how CMBS portfolios change, and to see if we'll call it the great experiment actually works.
Mike, we've seen in the last several weeks, a dozen or more states get involved and take action on eviction moratorium and rental assistance and other things. How do we disentangle that? Because obviously every state has different legislative bodies and people that are interested in helping their local landlords and tenants.
For sure. And Martha, thanks for the question. Let's start with one aspect just to level set, and just a reminder to the audience that the federal eviction moratorium that goes through March 31st is really a floor. So to Martha's point, if a state has implemented an eviction moratorium itself, and it has stronger controls than the federal eviction moratorium, then the state eviction moratorium takes precedent. So if you're a servicer, it's really important to pay attention to all 50 states. And to that point, an easy plug for MBA, we have an eviction moratorium tracker for all 50 states, as well as a rental assistance tracker. So you can see which states are offering rental assistance or the allocation of money they've received from the feds, as well as how their eviction moratorium work and how long they last. And to your point, Martha, two significant events that we're focused on is New York just extended its eviction moratorium through May, and that includes small businesses that have up to 50 employees. So that is something we have to keep an eye on. And then, of course, in California, they did something very different. They implemented their eviction moratorium, but at the same time, if in the multifamily space, again, if you are an owner and you agree to forgive 20% of the rent in arrears, the state of California will pay 80% of the rent in arrears for your tenants based off of the allocation of rental assistance they've received from the federal government. If you decide as an owner not to do that, then they will forgive up to 25% of rent in arrears. So to your point, Martha, if I'm in servicing and I have to keep track of this all, it's very difficult. So hopefully through our rental assistance tracker and eviction moratorium tracker, it makes it just a little bit easier to follow along.
So you're both located at home these days, or are you going into the office?
Well, to be a human for a second with a 5 and 8 year old, and starting this job less than a year ago, I come in on Tuesdays and Thursdays to get a little production done, but I'm at home Mondays and Fridays. So I do a little bit of both. Though that said, our offices are closed and we're 100% voluntary as far as coming in.
Yeah, so I think we're sort of exhibiting a little bit of the dichotomy or the schizophrenia of the office market right now. While Mike's in the office, I'm working from the home office as I have been. So it's sort of an indication of the mix that's out there.
Well, here's hoping we see you in person at an event sometime in this year.
San Diego, please. I actually was looking at my calendar on my phone, and I've talked about this on the podcast before, but I was traveling like twice a week on planes for the first 2 months and change of 2020. And I'm pretty sure the very last trip I took was MBA. And I took a red eye home and went directly from the airport to the Rainbow Room for a very interesting meeting on the way. That's just a little inside baseball there.
A little trivia.
But hopefully that's, maybe that'll be my first trip after COVID.
Wouldn't that be something? Well, with that, we'll close this special podcast. Thank you to our guests from MBA, and thanks to our producer, Haley Keene. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question, send us an email at podcast@trepp.com. Please visit trepp.com for more info and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.